This is Barry Knapp with Ironsides Macroeconomics. It's Sunday, October 31st. For most of you, that means Halloween. For me, it's a big transition day. It's the closing day at my golf club down the valley, and a snowstorm is rolling in as we speak with snow in the forecast. Every day this week in the front side of Vail, sort of covered. Currently, we're due to open up for skiing on November 12th. One other housekeeping note: I will be traveling this week. Hopefully, I won't have any issues getting my note out as usual on Saturday morning. But I'll be down in Nash Vegas at the end of the week and over the weekend. So there were 5 sections to the note this week. It was a particularly meaty report. The first section we titled "Central Banker Epiphanies." By the way, the title of the report this week was the ironic word of the year. That, of course, is transitory, whereas last year we thought the ironic word of the year was unprecedented, which is what the word that most people leaned on to avoid making any forecasts last year. We didn't think it was unprecedented, nor do we think that inflation is transitory. So back to my table of contents for this week's podcast and video. The first section we titled "Central Banker Epiphanies," and that was all about what happened in the middle of the week with some aggressive central bank action that caused a big yield curve flattening episode in the U.S. The second section was about our forecast for the 2022 capital investment boom, or capex boom. The third section of the note was a preview of all what's coming this week. We called it Macro Week. We then did a little bit on an earnings wrap up, because we're through the 3 weeks, which is really the meat of earnings season. And then the final part of the note was kind of a tongue-in-cheek, bit of a fun commentary. It was deflation versus hyperinflation, the Twitter war between Cathie Wood and Jack Dorsey of Twitter. So starting with the central bankers' epiphanies, the Bank of Canada shockingly went cold turkey on their QE program rather than tapering it. They just ended it Wednesday of this week. That was followed by a 150 basis point hike by the Brazilian central bank, with a forecast that they'll likely go another 150 basis points in December. That was at the end of the day. And then that night, the Reserve Bank of Australia decided to end what effectively was yield curve control. What they were doing was buying up all of the April 2024 notes to try and keep that rate at 10 basis points. They stopped buying that note, and the short 2-year note in Australia went from 20 basis points to 76 basis points over the next 2 trading sessions. So that was quite a move. Meanwhile, the Fed policy proxy, which you can see here in our first chart, continues to move sharply higher in the US. And so what that started to trigger was a lot of concerns that the Fed was going to make a policy mistake by tightening too aggressively, that the terminal Fed funds rate, or the peak of the Fed funds rate this cycle, which of course was 5.25 in the 2000s, only went to 2.5 in the 2010s, would be even lower this time, and the economy would be choked off because of all the debt. We, of course, don't believe all this. We think that our start, or the neutral rate, is actually going to be significantly higher this business cycle than it was last cycle. Private sector debt is much lower. The non-financial corporate sector debt barely increased during the 2010s, from say 41% of GDP up to 49%. They've termed that out. The duration of the old Lehman, Barclays, Bloomberg, whatever it's called now, investment grade credit index is over 12 years. So that debt's been termed out. The household sector is in great shape from a debt perspective. Financial obligations ratios, that's a percent of disposable income that goes to servicing debt, has never been lower since the Fed's been measuring it beginning in 1980. We just don't see the economy as sensitive to debt. We do see the government as being very sensitive to increases in rates, but that's a whole other financial repression story. So we'll leave that one aside for now. But because of the low levels of debt, because we think the demand for capital is going to be much greater and productivity is going to be stronger, we think that that R star number, or the level that the economy will start to respond negatively to higher rates, is significantly higher than it was in the 2010s. That was the aftermath of a financial crisis with debt overhangs. That's not the case today. So if you move on then and you think about the Fed's policy reaction function, they got hit over the head with a 2x4 on Friday morning with the employment cost index. It only comes out quarterly, but that is their favorite wage measure. The way it's constructed resolves a lot of the various weight problems, mix shift problems that the average hourly earnings series is plagued by. For example, that was really weak in the 2010s because we had retiring baby boomers and the millennials coming in and boomers going out, and that was plaguing that index. The ECI is much better constructed, but it's running for private sector wages and salaries at 4.6% annualized. That is white hot. And if you combine that with the consumer confidence surveys that came out last week, the Conference Board measure, University of Michigan member, and a very good series by Morning Consult that does great work on this stuff, it's pretty clear that inflation expectations are driving confidence down, not economic activity or the labor market. And so that really is Powell's inflation process. It's driving up wages, increasing wages, driving up inflation expectations. And that's an issue for the Fed, but the Fed, as we've been saying, is handcuffed by their process. They want to taper over 6 to 8 months. They want to then wait, and then they want to raise rates no faster than once a quarter once they've gotten to that point. So it would take quite a bit for the Fed to change that outlook. And quite frankly, we don't even know what the 2022 Fed is going to be. Biden's busy working on the environment and hasn't done what typically would happen at this point, which would be to either reappoint or not the Fed chair. And as we've been saying, we think that the Clarida seat is even more important for the monetary policy direction of the Fed in 2022. So a couple other quick comments on all this yield curve flattening, which we think you should fade. We do think it'll steepen back out. There's a real tax effect here as well with this struggles of the Democrats to push through their spending plan. And we got the framework for an agreement last week. It does look like corporate tax hikes are going to be lower than expected. This will have an effect on our capex outlook as well, which I'll get back to in a minute. It is a positive for equities, not raising corporate taxes, but the deficit outlook is much smaller than most, including us, were expecting as well. Ostensibly, it's $250 billion. We don't think they'll collect that much revenue, nor does the Penn Wharton budget model. But that notwithstanding, there's an allowance for a 1.75 trillion increase in the deficit under the reconciliation instructions that were filed this summer, and we're only looking at 250. Meanwhile, the Treasury General account, which most people thought those balances would start getting rebuilt, which would drain liquidity from the market, the Fed would pick up issuance, was going to happen faster than it actually did after they got the 480 billion increase in the debt ceiling. We did have an uptick in the TJA balances last week. There was pretty good issuance, but that's happened slower than most market participants thought that was going to happen. So we think that also contributed to the flattening because you didn't get the supply in the long end that we were expecting. All said and done, we still think you will get further steepening once we get through the Fed, and Powell will struggle to deliver a dovish taper. Nonetheless, we still favor a steepening yield curve and higher rates at the back end over time. Okay, one final point here is typically when you get a serious hawkish move in Fed and global monetary policy expectations, that is the kind of thing that could trigger a risk-off event. Offsetting this is the lower corporate taxes that we mentioned, favorable seasonality, and an improving growth outlook. Now, earnings won't get pushed up all that much. Earnings expectations won't get pushed up all that much, but revisions may be bottoming. Still, though, we think that the growth numbers are going to get better in the coming months, probably starting with next Friday's payroll report, or this Friday's. So on to the capex boom. We wanted to do an update. We got a lot of data last week on capital investment. We got the regional Fed surveys that have capital spending plans in them. That's a very good leading indicator for actual spending. We got the durable goods report. We got the GDP report. And the outlook is quite favorable. And of course, bottoms up S&P capex, which we calculate by drawing that out of the various companies reporting. And all this stuff looks good. You can see this chart, S&P 500 capital spending chart is improving pretty sharply along just trailing earnings as you typically expect it to. Our case for a very strong capex cycle in the 20s is restructuring of global supply chains. It's capital for labor substitution, given the tightness of the labor market, retiring boomers, for example. A decade of very weak capital investment last cycle, underinvestment, that is, manufacturing digitization and more automated, efficient manufacturing. And it looks like the Tax Cuts and Jobs Act will not be reversed. You got a lagged effect when you did the 86 tax reform. The boom came in the next business cycle. We think we're set up for something similar this go around. So one thing that we would really note out of those CapEx surveys is service sector CapEx plans are running very strong. They strengthened at the end of last business cycle. We talked a lot about capital for labor substitution. They've strengthened even further. We think we'll see a lot of that in the 2020s. So on to big macro week. We're going to start the week out with PMIs. We got China over the weekend. They were weaker than expected. They'll probably be softening a little bit, but we will be looking for signs of inventory restocking, of supply chains easing a little bit. That's what we'll look for with the PMI data. Of course, Wednesday brings the FOMC meeting, and we'll get out a note if we have something profound to say about that on Wednesday afternoon or Thursday morning at the latest. And then payroll Friday. And payroll Friday looks to be really fascinating. We do think there'll be some improvement in participation, but we do not think that will soften the wage growth momentum. We think that's going to remain strong. We think there's a lot of risk for, excuse me, a much bigger drop in the U3 unemployment rate and U6 underemployment rate than the street is looking for. Our reason for thinking that is a conference board labor differential number was really strong last Tuesday. That correlates very well with U3 and U6 unemployment rates. So we look for a strong report this week. I think we'll get a big headline number, and we think we'll get better participation, but still strong wage growth and a falling unemployment rate. So that's in on payroll Friday, and obviously we'll write something about that in our note this week. Earnings wrap up. I think the bottom line here, probably the most important statistic, if you will, coming out of earnings season is during the first 3 weeks of 2Q earnings season back in late July, early August, the S&P 500 bottoms up number increased by 4.1%. So that was a pretty good jump in 2021 earnings expectations. Now we're obviously later in the year, so you can't have the same effect, but that same estimate during the first 3 weeks only went up 1.3%. Revisions may be bottoming. The last few readings have been a little bit better, but we don't have the same earnings momentum that we had earlier in the year. We knew that the growth numbers will get better. We still think the 2022 numbers are too low, but that's probably the bottom line from an aggregate perspective. Financials and energies stocks have been responding very well on the day their earnings come out. Telecom, services, tech, and industrials have not been responding well, but we do think it's notable that industrial sector margins are recovering really rapidly. That was one sector that margins hadn't really gotten back all the way. They are coming back strongly, and what we see is a contracting differential in the various Fed surveys between prices paid and prices received. They're both starting to tick down a little bit, so we do think margins are going to continue to go up for the industrial sector. That's it on earnings. And then the Cathie Wood and Jack Dorsey Twitter battle we thought was quite amusing. Cathie Wood said something to the effect that tech innovation, creative destruction, and cyclical factors make deflation a bigger risk than inflation. We think she's totally wrong on that. About 20 years late on technology innovation, we commented extensively about how it really even started to kick into the service sector late last business cycle. But the three sectors that really remain for technology innovation adoption to start to slow price gains are housing, education, and healthcare. And those three have a major impediment to really improved efficiency and stronger productivity, and that's major government involvement. So, you can think about the energy sector the same way. And when the government gets involved, efficiency goes down. It's just a fact of, it's an empirical observation even, it's not theory. So we think she's totally off on that. And as far as creative destruction goes, I think she's kind of ignored this thing with the Fed and how they will just drive real rates to unprecedented levels and keep zombie companies alive and all. And so we think she's really wrong about that. And of course, Jack Dempsey talking about hyperinflation means that he's skipped straight from the 50s to the 70s and forgot all about the 60s and reflation. And we've written a ton about that as well. So we think they're both wrong. We are in a reflationary regime, and it's going to persist through the 2020. So that was it. That was probably a pretty long one this week, but hopefully you found it interesting. And if you're not already a paid subscriber to get in and dig into all these details like our note does every week, we'd love you to consider becoming one. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thanks.